Just starting your day. Excellent. Okay, so I think we've been given the go ahead to start, so we will begin. Welcome, everybody, to this webinar where we're going to talk about price action and indicators and how we can use them for a better trading system, ultimately. Sandy's just starting your day in New York. Very nice. You missed a few good moves this morning. But I'm sure you'll catch a few this afternoon in any case. So, for those of you that don't know me, my name's Alex Ong. I've been trading for almost a decade now with my brother. I don't have any special banking training or anything like that. We kind of started where you guys started. We now consult for a private investor fund in Europe, and we've been running Traders Corner for about 5 years now. And we've taught many people our strategies all over the world. And if you want to follow me on Twitter, the handle is @AlexOngUK. Okay? So, what we're going to talk about today, why most people fail to ever make any money in the FX markets or indeed any trading markets. We're going to discuss the indicator myth, as I like to refer to it, and why people fail with indicators. Then we'll talk about the benefits of using indicators and how we can use them in our trading. And if we've got time, we will also show you a strategy that we use that does use indicators and price action, and it's actually one of our most effective strategies. Okay? So, 90% of traders fail to ever make any money. Who's heard that before? Hands up. I can't hear you, so just a yes or a no in the chat box will suffice. Anybody heard that before? That huge number of traders that fail? Okay. So why do traders fail? Right? And there's a number of reasons. Undercapitalization is one. Unrealistic expectations is another. So people get sold the dream of making millions and millions of pounds. And all you have to do is follow one particular magic signal and all the riches in the world become yours. Wonderful. And that sort of goes hand in hand with not really willing to put in the effort. So a lot of people are only looking for those magic systems. There aren't a lot of people that want to put in all of the effort. There's a bit of a gambler's mentality as well. So you go from taking calculated risks to just literally trying to jump on anything that moves just in the hope that you might get lucky. And also traders focus on the wrong area of education. So people look for the magic system instead of actually looking into themselves and seeing what works for them, what sort of a person they are, and hence what sort of a trading system they will need to trade. All right? So there's just some of the reasons that traders fail. So the question, are indicators really that evil? Who's seen it written in forums? I have millions of times. When I ditched the indicators and cleaned up my charts, my trading changed. When I just traded naked charts, pure price action, suddenly I started to make money. Anybody read that before? I'm guessing a few of you. Right. So is that the real story? You see, I don't think it is. From my perspective, I think that it's got something more to do with traders understanding the markets. All right. So a lot of traders, when they start out, they get drawn by some sort of a magic system or something like that, and they get drawn to trying to basically trade indicators. So if the indicators tell them to go up, they'll be buying. If the indicators say it's going down, they will sell. But what they're not doing is they're not taking the bigger picture into perspective. So they don't really understand the charts. They don't really understand trading. They're just trying to follow a system blindly. And then after a number of years, after failing at using indicators and different magic systems, finally, people take all of the indicators off of their charts and suddenly they start to be able to make money. Now, from my perspective, I don't think that that's a coincidence. I think it's got more to do with the traders finally accepting that actually there isn't a magic system out there, that you have to look at the overall market context and you have to understand what you're doing in order to be successful trading. Now, That doesn't mean that you can't be successful trading with indicators on your charts. Of course you can. And I'm going to show you some very, very successful strategies that we use for doing just that. Okay. But as I said, so basically from my perspective, I think that it's not the case that indicators are evil. It's more to do with the fact that people use indicators at the wrong times in their trading career. So instead of focusing on understanding the markets, understanding market structure, momentum, market condition, all of that sort of good stuff. Instead of trying to understand that, they want this magic indicator that does everything for them. So after a number of years, when they finally accept that maybe they need to understand that, they go from one extreme to the other. So they take all of the indicators off of their charts and start looking at price action, and suddenly their trading improves. So is there a balance? Is there something in between that we can use to ultimately make our trading even more consistent? And my answer to that is yes. And we're going to get to that in just a few moments. So ultimately, indicators are definitely not evil, but this is how people start out. Has anybody seen a chart like this before? The one in front of them. So we've got the Euro Aussie. I've thrown 1,000,001 random indicators on the charts. And let's see if anybody can make money from this chart. So basically, a new trader will come to the market and they will probably have a system where they'll say, you know what, when the market hits the top of the band, I'm going to sell. When the market hits the bottom of the band, I'm going to buy. And a lot of the time, that will make you money. However, when the market starts to trend, so like on the left-hand side here, when the market's obviously broken through structure to the left and it starts to trend to the downside, you'd be buying there and there and there and there and there. And if you get down to here, your trading accounts will be just a fraction of what it was before you started. If you don't get down to there, you would have thrown that system in the bin and you would have looked for the next latest and greatest system. All right. So the problem is that people are looking for that magic combination of things that will ensure that they never take a loss. So what if we were to have a system where you do take market structure into account? Okay, so you have a system where you do look to buy and sell the top and the bottoms of the bands, but you only look to do it, okay, when the market condition is agreeing with you. So for example, you may be looking to buy over here, but once the market has broken structure to the left, you don't want to be a buyer because the market is in a downtrend. So you would therefore miss all of this price action down here. So where other traders, new traders, will be losing because they don't understand price action, they don't understand market structure, you as a person who are putting things into context, actually you wouldn't be trying to buy down here. You'd in fact be looking to sell. So the only opportunity you would have taken once the market broke structure is you'd be looking for a sell opportunity when the market came up to the top of the band. And you can see that gives you much higher probability trades, even just taking a simple, I believe this is it's either a Bollinger Band or a Keltner channel. I forget which one I threw on there. It's arbitrary at the end of the day. All right. So as you can see here, trading with an indicator on your chart, it can help you. And where I think it really helps is ultimately it gives the trader confidence. So you understand market structure, or hopefully you guys do by now, or you're going to start to look into it. So once you understand market structure, then what you want to do is you want to come up with a trading system that suits you. Now, if that means throwing an indicator on there to help you confirm what you're seeing on the charts is actually what's happening. So let's say, for example, you see that this is in a downtrend here from a pure price perspective, and then obviously the channel's pointing down, then you're looking for sell opportunities, and you get to the top here. If your system would say to sell, and you've got that in conjunction with what a technical indicator saying to sell, okay, then ultimately you're going to have a much higher probability trade because you're trading in the direction of the trend. Does that make sense to everybody? So can I define market structure? Yes. I'll define that in just a few moments, Boyke. Okay? So what is the key? Well, I think this one thing here that I'm about to show you, if you can add this into your trading Whether you trade with indicators, without indicators, or whatever it is that you do, you will increase your chances of success a great deal. Okay? And what that is ultimately contextualizing price. Who's done that before? Who zooms out, who zooms out from their chart, okay, and sees what the price is doing, not just on one time frame, but maybe multiple time frames. So instead of being zoomed all the way in and only seeing 6 or 7 bars on your screen, actually you can see a few hundred bars. Because when you do that, and you do that on multiple time frames, suddenly you get a better idea of where the overall market is going. And once you've got a better idea of where it's going, then you're going to be in a better position to be able to make money from it. And I'll demonstrate this now. So this is a 1 hour chart. All right, this is a euro dollar on a 1 hour chart. And as you can see, it's trending down. Does anybody disagree with that? Who here is happy that ultimately this chart is making lower lows and lower highs? So it starts in the top left-hand corner and it finishes in the bottom right-hand corner. Are we all okay with that? Yes? Okay. So Boyke's the only one on this session today. All right, so 1 hour chart is pointing down. 4 hour chart. 4 hour chart is moving sideways, no? So if we go back to the 1 hour chart, this is in a downtrend. That same sort of period of time there on the 4 hour chart, actually, it's not really a downtrend, is it? What's going on here is the markets are just moving sideways. All right, so whereas if you were trading the 1 hour chart and you get to the bottom here, you'd be looking for a sell because the market's moving downwards, lower, lower high, lower low, lower low. You'd be looking for a sell opportunity here. We move on to the 4 hour chart. And actually, that's that sort of period here. That downtrend on the 1 hour chart, suddenly you can see that you're coming into a bit of resistance in a congestion zone. So the 1 hour chart's trending downwards. The 4 hour chart is actually consolidating, right? Let's take another step back. Exactly. How about the daily chart? Well, this here, that is that same consolidation period on the 4 hour chart. So actually, when you look at the daily chart, you can see that the market's just made a huge move up. It's pulled back about 50%. It's at market structure, so previous level of resistance here. If we drew a line in across there, you would see that that is now actually becoming support. So whereas on the 1 hour chart, we had a downtrend, on the 4 hour chart, we had consolidation. On the daily chart, we've got a huge up move. There's absolutely no merit in looking for a sell opportunity coming into these lows here. All right, because you're coming into market structure, you're coming into a previous level of resistance, which has now become support. The markets have a memory. They will react to those levels. When it gets down to that level, if you're lucky enough and you're selling, it will just smash through it and trigger a whole load of stops and take you to your profit target. More often than not, it won't get through the level. It will bounce from the level. And it will bounce in the direction of the overriding trend. It will bounce in the direction of the traders who made money last. And the last traders to make money on this chart, in reality, are these traders that were buying the market from here, from 118 all the way up to 132. The market then pulls back to around 126. What do you think these traders are thinking over here? All of the market participants that were buying the market from 118, they're thinking, I made some nice money there, traded that for over 1,000 pips. We've had a decent pullback, about 50%. What do you reckon we could do that again? So they buy the market again. The market has a memory. Why? Because the markets are made up of human beings. Yes, there are some automated systems out there, but the big money, the big moves, the big trends are going to be driven by human beings making the decisions. And they remembered making all of this money here. So the next time they get an opportunity to buy the market again at what they feel is fair value or even a bargain, they will do that. And more often than not, they will win that battle. Does everybody follow that so far? Excellent. So, understanding market structure, what if we were to put together another trading system? Again, arbitrary trading system. All I've done here is I've thrown the MACD on the bottom of the chart. All right, so we've got the MACD on the bottom here. Settings are absolutely standard. So what if we were to take an absolutely arbitrary system and combine it with price action? All right, so what we're doing here is I'm introducing you to something known as divergence. And what divergence is ultimately the chart telling you one thing, but the market's telling you something else. All right, so if we look at this chart here, the market breaks below this structure point here. It comes up to it, it treats it as resistance. Now we've got a level, all right, that we've identified. We've got a level that potentially we can trade from. So the next time the market comes up to this level, from a price action perspective, we're going to be looking to sell. Okay, because we want to sell resistance. We don't want to buy into a ceiling. We want to sell resistance because that's the highest probability trade. We know that the markets are selling off because that's what they've done here. So the next time the market comes up to this level, which we've already referenced to the left here once and twice, and actually if you go back, it's referenced a little more. Right, we already know we want to sell there. All right, we get our price action at the top there. And if we throw an indicator into the equation, so we've got the MACD here, we've got something known as divergence. So if you look here, the MACD makes a high, right? In the same place as this market makes a high here. The market then sells off a bit and comes back to that same high, to the same price point. However, the MACD, all right, the MACD actually makes a lower high. So what does that tell us? What that's ultimately telling us is that there's nowhere near as much power in this move here as there was in this previous one. So if there's not as much momentum with this move here, and that move sold off, then potentially this one could sell off again. And the market comes back up to that level, and again, we've got an even lower high on the MACD. And what happens? The market sells off again. So there's a very, very sort of short, easy, what is the word for it? Example, sorry, of how an indicator can help back up your trading decision. So you can see that actually at this point here, we're trading price action. I've got support and resistance on my charts. I know where I'm looking to be taking where I'm looking to take my sell from. And actually it's wonderful because if we look at the bottom here, the MACD also confirms that. Does everybody understand that? So I'm not saying that you should trade this trading system. This is just an example of any sort of trading system. Okay, I could have thrown anything on there, RSI, whatever. It all would have shown something similar. So where I think indicators can help you as traders is it can help give you confidence in your trading decisions. So rather than having to rely on your own judgment on whether that is a decent level of support or resistance, you can also use an indicator to help back that up. Now, you don't trade blindly from the indicator, so you're not trading just because the indicator says to go short. No. What you're actually doing is you've already made the decision to go short and you're looking for confirmation from the indicator. And that is how you should use indicators to be successful. So, let's ask you a question. What are you doing today? Are you moving your stops? Who negotiates with themselves? Who's ever been in a trade, put their stop in place and said, actually, you know what? That's a little bit close to the market. I'm going to just take a step back. I'm going to move my stop a little bit, give it a bit more room to breathe. And you'll reason with yourself, you know. You'll make it sound like it's an intelligent decision. You'll say, well, actually, I need to give it a bit more room to breathe because I can see that the market is going to go in my direction. And I believe that, you know, the fundamental trend is up and all of that. So I'm not going to strangle my position. You know, I'm going to move the stop a little bit further away. And that should keep me out of trouble and make sure I make money. Who's ever done that before? No one? Oh, you did. Kamikaze, yes, exactly. And once you've done that and you've been stopped out, who's then been in a position where they're nowhere near where their profit target was, but they've got some profit on the table. So now they're like, well, actually, you know what? There's some profit there. That's real money. I should be prudent. I should be smart here and take my money off the table. And it's not where you initially intended to take your money off the table, but just because the market is kind of fluctuating a little bit, it's losing a little bit of momentum, you're like, actually, I need to take that off the table because I do not want this winner to turn into a loser. Many of you? Yes. Don't worry, you can all admit it. We've all done it. All of us have done it. You've made every mistake in the book. Don't worry, me too. I've made every mistake as well. And then you do things like you miss opportunities, right? And you try to make up for your mistakes. You'll miss an opportunity, and then you'll try and jump in on a trade. And this is one of the biggest killers for an account, I believe, right? Because what happens is when you miss an opportunity and you get in late, let's say, for example, you were in a trade or you were looking at a trade which you were, if you got in when you meant to, you had a profit target 20 pips away, all right, and a stop that was 10 pips away, okay? So you've got a good trade on there. You've got a nice positive risk reward. So you're going to make 20. You're only risking 10. Wonderful. You have a cup of tea. You walk away. You come back to your screen and the market's moved through your entry 10 pips and you're not there. Then you get into the market and you keep your stop where it was because it's the right place to put it. It's a structural point. Fair enough. And you also keep your profit target where it was. So by the market moving 10 pips, all right, and you getting into the trade 10 pips late, what's happened to your position? It's gone from a position where you only had to be right less than 50% of the time to be able to make money because you had a 2-to-1 risk reward. You flipped that on its head, and now you've got to be right at least 75% of the time because for every 2 that you make money on, it will only take 1 to wipe out your losses. Because instead of a 20 pip profit target and a 10 pip stop, now you've got a 20 pip stop and a 10 pip profit target. Sound familiar? So what are the other trades? Paralyzed by analysis? Too scared to take a trade in the first place? Anyone? Taking a string of losses in a row and suddenly you're in a point where you're like, do I have to put this on? I know I have to be in the market. I know I have to, but I just can't bring myself to put that trade on because if I lose it, I don't want to lose the money. I don't want to be a loser. I don't want to be wrong. You know, we've all been there. So what is the answer? Well, the ingredients of a successful system, for me personally, this is what I think you need in a successful system. You need to identify levels where price has the potential to accelerate through and not look back. The system should have the ability to identify the trend. It should have the ability to identify momentum. That's different to the trend. A lot of people get that confused. The trend is a direction the market's moving in. The momentum, okay, is the velocity at which it's moving. How quickly is it moving in a particular direction? Is it meandering, kind of going very, very slowly? Or is it smashing through levels without looking back? It must have a way to assess the overall market condition. That's kind of taking everything into account. Where all the previous support and resistance levels are, what's the momentum, which way's the trend going? And most importantly, the system, it must have clear, repeatable rules for entering and exiting the markets. Okay? There needs to be rules that you can repeat and do over and over again that will allow you to be successful. All in agreement? So now I'm going to give you a system, all right, that has served us very, very well over the years. And this system is based on range bars. Who here has heard of constant range bars before? Excellent. Nope. Okay. So constant range bars, what are they? Well, constant range bars are, or constant range charts are charts with candles on them, which are exactly the same distance from high to low. All right, so the range of that candle is exactly the same distance. So what does that mean? Well, for a new candle to print, the range has to be exceeded. So whereas with a regular candle, you can see that you have a wick at the top and a wick at the bottom, and the opening and the close can be somewhere in between. With a range candle, that can't be the case. Why? Because we are eliminating time from the equation. We are saying we're only interested in trading when the market is moving. If the market is not moving anywhere, we have no business being there. All right? So the market, the range charts ultimately eliminate time from the equation. And let's think about that for a second, right? Price in reality is along one axis, isn't it? The price can either go up or it can go down. Do you agree? So the market can tick up or it can tick down. So if we agree on that, where does consolidation come from? How can the market move sideways? Because if we only had a decision to make based on whether it would move up or down, I'm pretty sure that we would be more successful. No direction, yeah, but how do we determine no direction? Why? Because of the axes along the bottom of the charts. This thing here, 9 o'clock, 10 o'clock, 11 o'clock, 12 o'clock, 1 o'clock, 2 o'clock, 3 o'clock, 4 o'clock. So what is that? That's time, right? So we have arbitrarily decided that we're going to trade a 5-minute chart. So what is important about this 5 minutes, this 5-minute period of time, or this 5-minute period of time, or this 5-minute period of time, or this one, or this one, or this one, or this one, or this one? What's important? Nothing. The only thing that's happened is 5 minutes has elapsed, print a new candle. 5 minutes has elapsed, print a new candle. 5 minutes has elapsed, print a new candle. So us as human beings, because we want a way of visually depicting the charts, us as human beings, we have added the time axis in there. It's us that have done that. Because in reality, the price can go up or it can go down. The only way it can go sideways is if we put time in there. Really. Does everybody understand that? You don't understand that. So the price can go, so Louis, the price can go up or down, right? The only way that it can go sideways is if we add time to the equation. So at the bottom of the chart here, you've got time. Every single one of your charts, if you're trading with something like MetaTrader, will be time-based. So it'll be 1-minute candles or 5-minute candles or hour candles or whatever candles. So the point is that whereas really the price goes up or down, the reason that it goes sideways is that we choose to visually represent the charts along a time axis as well. That's why it goes sideways. So the system I'm going to show you eliminates time from the equation. So this is a 5-minute chart here. This is a range chart there. Looks drastically different, doesn't it? This is a lot easier to trade. So our system, well, I say it's a swing trading system, but you can day trade it as well. But for those of you that are new to it, I would recommend that you swing trade it. It's a laid-back system. You have on average 3 to 5 trades a week, and you could be holding a position over a number of days. Now, you can day trade this as well. I personally day trade it, and I trade it on very, it's not time frames, but short range charts. So I'm very close to the action, price action. Okay? So the chart setup, your chart of choice, whether that be an 8 range, a 10 range, 15 range, whatever looks best to you. All right? You then have 3 moving averages. The 3 moving averages are the 25, the 55, and the 100. You then throw onto your charts stochastics. The period D is 3, period K is 7, and the smoothing is 3. And you have a 7-period CCI. All right, so as you can see, we're trading price and price action because we're using the range charts. We're then adding indicators to this to help confirm our decisions. So, for a long entry, the rules are the 25 moving average has to be above the 55 moving average. The 55 moving average has to be above the 100 moving average. If that is the case, then you have permission to go and look for something to trade. You aren't allowed to trade it. You can only go looking. Make sense? So the moving averages tell you whether you're going to be long or short, and if they aren't lined up, so if the 25 isn't above the 55 and the 55 isn't above the 100, or the reverse, so the 25 below the 55 and the 55 below the 100, you do not have permission to look for a trade, if that's not the case. Moving averages give you permission to go looking for a trade. So, what is our entry for a long opportunity? The stochastics have to cross to the upside. All right, so your faster moving average will, on these stochastics, will move from below to above the line. So in this case here, we've got the blue one is below, and that moves above the red line. That's our signal to go long. The CCI, and this is important, the CCI must not, for a long opportunity, the CCI must not be below negative 50. It cannot be below negative 50. Anywhere above there is fine, but it cannot be below it. Once you've got that, you can then enter the market. For a short opportunity, the 25 needs to be below the 55 and the 55 below the 100. You then wait for your stochastic and your CCI to cross accordingly. So the stochastic crosses below, and the CCI cannot be above positive 50. Okay? And that's it. They are the simple rules for entering the trade. As far as stop losses are concerned, your stop goes behind your swing, and your profit target is initially 1-to-1, and then you can see where it goes and how quickly it goes. When you start to, you can add a bit of discretion there. All right, but the trading system is very, very simple, and I think this is probably going to be recorded, so you'll be able to come back here and watch it again at some other points, unless FX Street haven't recorded this, but they record most, so you should be okay. And this does work on, it's not time frames, remember. Well, you could apply this to a time-based chart if you wanted to, but these are based on range charts. Range charts aren't are based on time. Oh. Luis, that is putting it all together. So the swing, going back to the short entry here, this is, you've got examples here on the chart. It's only a 45-minute session, Lewis, so we can't go into loads and loads of great detail, but there will be a recording, so you can come back and see these. Okay? But this here should be enough to give you an idea. And if you come back and look at the recording and take screenshots of the recording, you should be able to get all of the rules for this system. I'm just conscious of time because I don't want to run over and not answer any questions that you guys may have. All right? But bringing it all together, ultimately what you want to do is you want the moving averages to be lined up. So if the 25 is below the 55 and the 55 is below the 100, you can go looking for a trade. You can look for a short opportunity. If the 25 is above the 55 and the 55 is above the 100, then you can go looking for long opportunities. Then you're looking, once you've got the permission to go looking for the opportunity, you wait for a pullback in the market, and then you can look for your stochastics to cross, so the stochastic cross and the CCI to be in the right position. Your stop will then go, if you're in a short trade, it will go above the swing, so above this point here. If you're in a long trade, your stop will go below the swing, so it will go below here. It will go below structure. Okay? And that system there is a very, very good strategy. It's a system that has served us very, very well over the years. Are there any questions? I haven't. Is it the same with a Renko chart? I haven't traded Renko charts, to be honest with you. Which range charts are best? Okay, so volatility has contracted somewhat over the past years. We found that historically the 45 range is best for swing trading, although over the past 18 months the volatility has contracted, so we found that we have even been looking at sort of like the 30 range chart for swing trades. On a day trading basis, I trade the 2 range chart. Where are you getting the range charts from on MT4? There's you've asked 3 questions. I haven't seen them, Greg. Sorry. Oh, it's in the Q&A box. I'm looking at the chat box here. You get the range charts from, well, there's a number of indicators out there available on MT4. FX Boyke, you won't really see a difference between them because they will look the same. The only difference is that one will be longer term and one will be shorter term. But as far as the actual chart, that is an 8 range, that's a 45 range chart there. If we go back a few slides, that's an 8 range chart. They look exactly the same. The only difference is that they're a different range. Okay, so a chart is a chart at the end of the day. It is what's that, Henkayashi? It's sort of, Henkayashi smooths the price action. And actually one of the strategies that I trade, I actually use range charts in conjunction with Henkayashi, and it's really quite cool. So maybe try that. Throw some Henkayashi onto a range chart. You will be absolutely amazed with the results. Are there any other questions, guys? Which time frame is that time frame, TF? Is that what you're saying? So I trade on range charts. And as a result of that, there isn't a time frame. So as I said, for the shorter term trading on the currencies, I'll trade the 2 range. For the longer term, somewhere between the 30 and the 45. When I trade the DAX, which is my absolute favorite instrument to trade, bar none, I have 4 of those charts. I trade the 4, 6, 10, and 15 range. But I really encourage you guys to give this system a go. You will not be disappointed with the results. I mean, you would be able to use it on a time-based chart, ASMA, but to be honest, I only trade it on the range charts. This is Ninja Trader. Ninja Trader is definitely the best charting platform. Yeah, indicators do lag, Boyke. That's why you can't use them as your sole sort of trading system. You have to understand price action. You have to understand market structure. But I would agree that they do lag. Do they work in all weather conditions? You mean sort of? Oh, that is quality. Boyke, have we ever met before? Have you ever been to one of our seminars or anything like that? I feel I've seen you on here for many, many years now, and I feel like you're an old friend. Have we met? No. Oh, that's a shame. Someday, somewhere. Where are you from? Yes, indeed, exponential moving averages. Oh, okay, cool. Yeah, that is a bit of a journey away. I'll be quite a drive and swim. Indeed, it might take more than one sunny day to swim there, but as fast as I am. The CCI settings is just a 7-period CCI, Danny. Are there any other questions, guys? Spun cut out. Andy, I keep saying, I've mentioned it a number of times, exponential moving averages, 25, 55, and 100. Can you hear me? Did you hear me, Andy? 25, 55, and 100. The stochastics are, there you go. You missed everything, Saeed. We're just wrapping up. We have like a minute to go before we get kicked off. Are there any other questions, guys and girls? Is there anything in particular you'd like to cover in our next webinar? The success rate of price action depends how you trade it. There isn't any one success rate, unfortunately. Contact, okay. have a little free gift for you. It's something that we set up when we did a presentation for the Barcelona Trading Point last month, which was very good. You should get along there if you can next year. But the contact details are in front of you on the screen here. So this is our email address. And we've even got like a free little gift for you guys. If you want, it's another trading strategy that we use. It's based purely on price action and time for those of you that can't access range charts for whatever reason. Okay. Something with ordinary charts for the next webinar. Yeah, but the thing is that I like to show you guys our most profitable strategies, you see. I want to show you what can make you money. I'll tell you what we might be able to do for the next one is we can talk about news trading. Maybe we can get together and trade the news. That's something that we do with time-based charts. Sort of. We use range charts as well. I always use range charts. Okay, great. Well, I will say thank you very much for having me. Thank you to everybody for attending. FX Street, thank you very much for having me. And until the next time, good trading, everybody. You can find the recording as we've just posted just down below then, the webinar archives. Until next time, good trading. Thank you very much. And I hope to hear from you all very, very soon. Thank you, FX Street, for having me. It's been a pleasure as always. Take care now and good day.